Carter loves dividend stocks. Every 3 months, cash lands in his account. Real money. Money he can see, money he can spend if he wants to. Jerry buys an index fund. No dividend strategy, no stock picking, no excitement, no quarterly income screenshots. Just the same boring purchase every month. If you asked most people which investor sounds smarter, Carter would probably win that vote by a mile. After all, Carter's getting paid. Jerry is just watching numbers move around on a screen. One strategy feels productive. The other feels passive. One sounds like investing. The other sounds like doing nothing. And for the first several years, Carter has all the evidence he needs to prove he's right. His account sends him cash. His coworkers admire the strategy. His portfolio feels alive. Jerry just keeps buying the same boring fund month after month. Carter thinks he's winning. On paper, it looks like he is. But is he really? To answer that question, imagine two 30-year-old friends living in the same city. Carter and Jerry both earn $75,000 per year. They're in the same tax bracket. They have the same retirement goal. They both want financial freedom by age 60. They both invest exactly $1,000 every month. Neither receives an inheritance. Neither starts a business. Neither gets lucky with cryptocurrency. Their lives are virtually identical. Only one thing is different. Carter puts every dollar into a portfolio built around dividend stocks and dividend-focused exchange-traded funds. Jerry buys a low-cost S&P 500 index fund and never thinks much about it. Carter's strategy is easy to talk about. He can tell people how much dividend income he earned last quarter. He can discuss yields. He can explain which companies paid him. His coworkers love hearing about it. Nobody at a barbecue has ever said, "Let me tell you about my index fund." Jerry has nothing interesting to report. No stories, no screenshots, no exciting announcements. Just a growing account balance. And that's exactly why what happens next surprises so many people. During the first year, Carter feels fantastic. His portfolio generates nearly $1,200 in dividend income. The amount isn't life-changing. But that's not the point. The point is that it feels real. Every payment reinforces the belief that the strategy is working. Jerry earns dividends too because the companies inside the index fund pay them. But he barely notices. Everything gets automatically reinvested. No excitement, no ceremony, just compounding. By year 3, Carter's annual dividend income climbs above $4,000. He starts talking about how his money is working for him. Friends nod approvingly. After all, who doesn't like the idea of getting paid without selling anything? Meanwhile, Jerry rarely discusses investing at all. His account balance has grown nicely, but there's no emotional reward attached to it. Carter has stories. Jerry has a balance. By year 5, Carter's portfolio has become part of his identity. He knows the names of the companies paying him. He checks dividend announcements. He tracks yield increases. The strategy feels active, intentional, sophisticated, and from the outside it appears successful. His portfolio continues rising. His dividend checks continue arriving. His confidence continues growing. But something important is happening beneath the surface. A slow leak. A tiny drag that compounds year after year after year. The kind of leak that doesn't show up in a single statement. The kind of leak that quietly changes your retirement. The mirage is starting to form. He just doesn't see it yet. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. To understand what happens next, you have to understand a concept that almost nobody discusses: total return. Total return is the combination of capital appreciation and income. In plain English, it measures how much wealth you actually create, not how much cash arrives, not how many dividends you collect, how much richer you become. This distinction matters because a dividend payment isn't free money. When a company distributes cash to shareholders, that cash lifts the business. Your wealth hasn't magically increased. Part of it has simply changed form. Researchers from institutions including S&P Dow Jones Indices and Morningstar have repeatedly shown that investors often confuse income with wealth creation, and that confusion creates several hidden costs. The first is return drag. Dividend-focused portfolios often tilt toward mature companies, utilities, consumer staples, telecommunications firms, large established businesses that prioritize distributions over growth. The problem is that slower-growing companies often produce lower total returns than the broader market. Historically, a broad S&P 500 fund has generated roughly 10% annual returns over long periods. Many dividend-focused strategies have generated closer to 9%. 1% sounds tiny. It isn't. Over 30 years, that single percentage point can mean hundreds of thousands of dollars. That's the first leak. The second is tax drag. This one is even more dangerous because investors barely notice it. Every time Carter receives a dividend payment, inside a taxable brokerage account. Taxes may be owed. The government gets paid before compounding can happen. Jerry largely controls when taxes occur because most of his gains remain unrealized. His money stays invested. Carter's money partially leaves the system every year. Imagine a small hole in a bucket. You may barely notice it today, but leave it there for 30 years and the difference becomes enormous. The third leak is expense drag. Many dividend-focused funds charge higher fees than plain vanilla index funds, not dramatically higher. Sometimes the difference is only a few tenths of a percent, but compounding works in both directions. A small fee repeated for decades becomes a large cost. The market never sends you a bill. The money simply disappears before you see it. The fourth hidden risk is concentration risk. Dividend investors often end up owning large amounts of the same sectors: utilities, financials, energy companies, industries known for paying income. The portfolio looks diversified because it contains many stocks, but economically, it's often making a concentrated bet. History is full of periods when entire dividend-heavy sectors underperformed for years. When that happens, the income remains, but total wealth suffers. Then comes the fifth and most dangerous trap: yield chasing. This happens when investors become obsessed with the size of the dividend rather than the quality of the business. A stock yielding 8% sounds better than one yielding 3%, until the company cuts the dividend, or the share price collapses, or both. Financial history is littered with examples of investors reaching for yield and discovering they were simply being compensated for taking extra risk. The higher income looked attractive. The future losses were hidden, and that's the recurring theme here. Nothing breaks overnight. Nothing feels wrong. The portfolio keeps rising. The dividends keep arriving. The statements keep showing gains. That's what makes the trap so effective. If I only showed you the downsides of dividend stocks, I'd be doing exactly what I'm accusing others of doing, telling half the truth. Because index funds are not perfect, not even close. Their biggest weakness is that they're unbelievably boring. That sounds trivial until you've actually invested for a decade. Humans crave feedback. Humans crave excitement. Humans want stories. Index funds provide none of those things. You buy them, you wait. That's it. The second weakness is patience. An index fund asks you to trust a process that may take 20 or 30 years to fully reveal itself. Most people dramatically underestimate how difficult that is. Everyone loves long-term investing until the long-term actually arrives. The third weakness is psychological. Carter receives visible cash. Jerry receives invisible growth. One feels tangible. The other requires faith. During market declines, that difference becomes emotionally significant. When the market falls 30%, many investors begin questioning everything. A dividend payment can provide reassurance. An index fund balance dropping on a screen can feel terrifying. The fourth weakness is social. Carter's strategy generates conversations. Jerry's strategy generates silence. People naturally assume complexity equals intelligence. A simple index fund feels too easy, too obvious, too ordinary. Yet finance has a strange habit of rewarding ordinary behavior. And that's the critical distinction. These weaknesses are real, but they're mostly behavioral. They're challenges of discipline, challenges of patience, challenges of psychology. They're not mathematical disadvantages. Notice how this list compares to dividend stocks list. It's shorter. The items are more situational. Most of them are behavioral rather than mathematical. To understand what happens next, you have to understand a concept that almost nobody discusses: total return. Total return is the combination of capital appreciation and income. In plain English, it measures how much wealth you actually create, not how much cash arrives, not how many dividends you collect, how much richer you become. This distinction matters because a dividend payment isn't free money. When a company distributes cash to shareholders, that cash leaves the business. Your wealth hasn't magically increased. Part of it has simply changed form. Researchers from institutions including S&P Dow Jones Indices and Morningstar have repeatedly shown that investors often confuse income with wealth creation, and that confusion creates several hidden costs. The first is return drag. Dividend-focused portfolios often tilt toward mature companies, utilities, consumer staples, telecommunications firms, large established businesses that prioritize distributions over growth. The problem is that slower-growing companies often produce lower total returns than the broader market. Historically, a broad S&P 500 fund has generated roughly 10% annual returns over long periods. Many dividend-focused strategies have generated closer to 9%. 1% sounds tiny. It isn't. Over 30 years, that single percentage point can mean hundreds of thousands of dollars. That's the first leak. The second is tax drag. This one is even more dangerous because investors barely notice it. Every time Carter receives a dividend payment inside a taxable brokerage account, taxes may be owed. The government gets paid before compounding can happen. Jerry largely controls when taxes occur because most of his gains remain unrealized. His money stays invested. Carter's money partially leaves the system every year. Imagine a small hole in a bucket. You may barely notice it today, but leave it there for 30 years and the difference becomes enormous. The third leak is expense drag. Many dividend-focused funds charge higher fees than plain vanilla index funds, not dramatically higher. Sometimes the difference is only a few tenths of a percent, but compounding works in both directions. A small fee repeated for decades becomes a large cost. The market never sends you a bill. The money simply disappears before you see it. The fourth hidden risk is concentration risk. Dividend investors often end up owning large amounts of the same sectors: utilities, financials, energy companies, industries known for paying income. The portfolio looks diversified because it contains many stocks, but economically, it's often making a concentrated bet. History is full of periods when entire dividend-heavy sectors underperformed for years. When that happens, the income remains, but total wealth suffers. Then comes the fifth and most dangerous trap: yield chasing. This happens when investors become obsessed with the size of the dividend rather than the quality of the business. A stock yielding 8% sounds better than one yielding 3%, until the company cuts the dividend, or the share price collapses, or both. Financial history is littered with examples of investors reaching for yield and discovering they were simply being compensated for taking extra risk. The higher income looked attractive. The future losses were hidden, and that's the recurring theme here. Nothing breaks overnight. Nothing feels wrong. The portfolio keeps rising. The dividends keep arriving. The statements keep showing gains. That's what makes the trap so effective. If I only showed you the downsides of dividend stocks, I'd be doing exactly what I'm accusing others of doing: telling half the truth. Now, none of this means dividend investing is useless. There are situations where the entire criticism falls apart. The first is inside a Roth individual retirement account. Inside a Roth individual retirement account, the tax drag disappears. Dividends can compound without annual taxation. One of the biggest leaks is gone. The second is ENSA 401k plan. Again, the tax issue largely disappears. The portfolio can grow without the yearly friction that hurts taxable accounts. Inside a tax-advantaged retirement account, the entire critique collapses. The third situation is retirement itself. Many retirees simply sleep better collecting dividends than selling shares. Mathematically, the difference may not favor dividends. Psychologically, it sometimes does. And psychology matters. A strategy that someone can stick with is often better than a theoretically perfect strategy they abandon. Finally, dividend stocks can work as a supplement, not as the foundation, not as the replacement, as a complement. A larger index fund portfolio paired with selective dividend exposure can provide both growth and income. Notice the pattern. Every single one of these wins is conditional, situational, or supplementary. Index funds win on total wealth. The goal of investing is maximizing long-term purchasing power. Over long periods, broad market index funds have consistently produced superior total returns. Index funds win on taxes. Most gains remain unrealized until the investor chooses to sell. That flexibility creates enormous long-term advantages. Index funds win on diversification. Instead of concentrating heavily in dividend-paying sectors, investors own hundreds of companies across the entire economy. Index funds win on cost. Low-cost index funds charge almost nothing. Every dollar not paid in fees remains invested and compounding. Index funds win on simplicity. No screening, no yield chasing, no constant analysis. Just systematic ownership of the market itself. And when simplicity produces more wealth, lower taxes, broader diversification, and fewer mistakes, the conclusion becomes difficult to ignore. The data is settled. The industry just doesn't want to talk about it because there's no money in selling people the boring answer. So what should someone actually do with this information? Start with a simple 3-step framework. Step 1. Build your core wealth using low-cost broad market index funds during your accumulation years. When you're 25, 35, or 45 years old, the primary objective is not generating income. It's maximizing long-term asset growth. Focus on building the largest portfolio possible. Step 2. If you want dividend exposure, keep it inside tax-advantaged accounts whenever possible. A Roth individual retirement account, a 401k, anywhere tax drag can be minimized or eliminated. That's where dividend strategies make the most sense. Step 3. As retirement approaches, gradually decide whether dividend income serves a psychological or practical purpose. 5 to 10 years before retirement is the time to evaluate income strategies, not 30 years before retirement. And that's the reframe almost nobody talks about. The goal was never to build the biggest dividend check. The goal was to build the largest pile of assets possible and then decide how you want to get paid. He never saw it coming. Most investors don't, because they spend decades optimizing for income when they should have been optimizing for wealth. And if you're wondering how real estate investing stack up against index funds, that's a completely different conversation. And the math might surprise you.